Okay, so let me talk through the big picture. It's a little bit of a change since our summer 23 commentary. There's certainly, in our view, some winds of change coming down the line, and quite a different picture than we had maybe been presenting. A little certainly in certain areas in particular from the summer commentary. Again, I know this is a concept we've talked about for many commentaries at this stage, but again, at this particular juncture, we're highlighting the dual aspect of the Irish economy, the twin track economic paths that we have for both the domestic sectors and the multinational sectors. If we focus first on the domestic sectors, how can we think about the big picture there? Well, we have an economy with the extremely low unemployment rate, so the labour market is operating at capacity. The public finances are in good shape, so we have continued growth in taxation receipts. But we also do have some early indications of a normalization or a moderation in the growth rate of the domestic economy. In particular, I'll talk about our path for consumption expenditure, which, with the most recent data from the CSO, we have revised down our path for consumption, in particular because some of the excess savings have been revisited with the data revision from the CSO, and we expect less of a kick available for household consumption from the savings channel. So domestically, economy is operating at full capacity. In terms of the labour market, it's performing reasonably well, but we are expecting a moderation in the growth rate towards more normalized levels. It's not unexpected following the twin shocks of COVID and the Ukraine war that we would have. We would leave maybe that period of volatility, and we would move towards a more normalized growth path in particular for household expenditure. In terms of the multinationals, again, that's an area where there's, we're seeing a divergent path. We are experiencing quite a sharp slowdown in some of the key export sectors. This is a feature in particular of the pharmaceutical sector. It's a feature of the exports in the machinery and equipment area. And so the goods side of the trade is moderating and moderating very sharply. They are sector-specific issues, and over and above that, there does appear to be a general decline in the overall trade pathway. We can see some moderation in some of the other traded sectors in terms of goods, and that's in line with the international forecasts for a more moderate growth path for trade, in particular for goods. Services is holding up pretty well, and the computer services exports are holding up pretty well in particular. In terms of the headline inflationary picture, obviously the energy price inflation has moderated over the period to the summer. However, we are seeing some stickiness in the inflation, with the declines observed earlier in the year appearing to taper off. And really the big risk there is that we're seeing some domestic factors taking over the inflationary impulses, and this is a potential risk that we may get a break in the moderation and in the inflationary path. So to just quickly run through the forecast table, we can see GDP here and MDD, the modified domestic demand figure. For GDP for this year, we are forecasting a decline. However, that is specifically related to the activities in the traded sector with the multinationals, which is pulling down the exports figures relative to where we were last year, and that's what's causing the decline in GDP. And next year we expect a uptick towards more normalized growth rates for exports, and this gives a 3.5% growth in GDP. For next year, in terms of modified domestic demand, for this year in terms of modified domestic demand, we are bringing down our growth rate slightly. We're just under 2% for this year, and picking up slightly to next year to 2.5%. So more of a normalized pathway for this particular growth. I think this picture can make it very clear in terms of outlining that dual economy aspect. The chart on the right hand, on the left hand pane here, shows the growth rate in GDP in blue and GNP in green. I think it's very clear since late 2001 that we've had this downward pathway for GDP. It's been declining quite rapidly, but that is that must be taken in the context of the very rapid growth that came with those huge elevated export levels from the multinationals in the COVID period. So this wouldn't be an unexpected moderation in the GDP growth rate. The chart on the right-hand pane really gives a lens into what's happening here. So the blue line is the year-on-year growth on a quarterly basis for gross value added in the foreign-dominated sectors, and the green line is the equivalent for the domestic sectors. And we can see towards the end of this chart that the drop-off is coming through those multinational sectors rather than the domestic sectors, which have just kind of normalized, which is our the phrase we're using here. So the has come down from that volatility of the COVID period and come to a more normal growth path. So this is very clearly depicts the dual economy issue. To talk through a little bit more about the components of the GDP, so where do we see the different effects coming through? What this chart shows is in the blue bar, it shows the year-on-year growth for the full year 22, and then the green dot is the year-on-year growth for the very latest data point we have, which is the second quarter of 2023. And what you can clearly see here is that the growth rate for the most latest data point is well below, in all cases, the last year's growth. So we're seeing that moderation. You can see it in consumption, government spending, investment and exports are actually negative, and imports have come down. So this is the moderating of the domestic side, so the consumption, government spending, and then the fallback in particular on the exports channel. So we can clearly see where this is these trends are moving. To move from the historical data to trying to give us a lens into where we're at present, we have information in the commentary from our nowcast. The nowcast is a collection of data that's put together into a model and gives us an in-time lens into where we see the economy present. And the orange bar here gives us our kind of in-time forecast for the quarter we've just exited, quarter 3. And you can see here it's a more moderate growth path. It's in and around 3%. So we've seen this growth path moderate over time. So we do expect growth in modified domestic demand for this year, which is what this indicator picks up, but at a level that's below what we've seen in the more recent past. To maybe give a little bit more insight into consumption, we've obviously lowered our consumption forecast from the previous commentary. We're at 3% for this year and 2.5% for next year. Why have we done that? Well, there's a number of reasons behind that. One, we've obviously exited the very volatile period from the public health measures, which were messing with the base data in terms of a year-on-year comparison. But 3 other factors I think are really, really important. One, we're seeing in the data a more moderate path for consumption expenditure. The chart here on the right-hand side shows retail sales across various different items in the retail sales data, and again provides that two-tiered comparison, the blue bar being the first half of the year this year compared to last year, and the green dot being the most recent data point. And we can see for many, many areas the trajectory is downward. So the green dot is below the blue bar. So you can see the downward trajectory for lots of different retail sales items. The other issues that are important to note are the inflationary pressures have been squeezing real incomes. So households have just less spending power in general. But then we also have the savings issue, which I think is worth pointing out. So the chart here on the left-hand side, the green line is the current data for the savings ratio. So you can see it's kind of gone back in the most recent data to where it was in the pre-pandemic period. The blue line here was the previous estimate that had been released earlier in the year, showing a much higher level of savings relative to where we were before. And actually, the downward revision here means we actually have bid down our consumption forecast because we don't feel like there's as much of an unwinding of the savings ratio to go into household spending as there previously was. So that's a key factor in the moderation story around and normalization story around the household spending. Is Ireland different? Always a good question to ask. The chart here on the right-hand side looks at household consumption expenditure for Ireland in green, and then a number of other European economies, some small open economies, and then Germany as a benchmark for the bigger economies. And you can clearly see there's a drop-off across the board in terms of the growth rates for expenditure. And there's a range of factors here leading into the broader European downturn. The rise in the interest rates is a critical factor, but also the inflationary impact on real incomes are all leading to more moderate growth paths for the domestic economies. Okay, so let me talk a little bit more about the export side before I hand over to Kieran to talk about the rest of the material. Exports have obviously been a hugely successful area for Ireland over the past number of years, in particular driven by the multinational sector. Huge growth, double-digit growth in exports. You can see 2022 here at staggering increases in exports. And they're really to do with sector-specific issues, pharmaceuticals in particular, computer services, which make up over half of our exports alone. What we're actually now seeing is a notable moderation in the path of exports. The total volume of exports in the second quarter of the year was down 3% on a year-on-year basis. And you can see our forecast table for this year. We're expecting much, much lower export growth, so only 1% this year. And what's happening behind that? Well, actually, ICT is holding up really well in terms of the service exports, but we are seeing a marked drop in the pharmaceutical exports and particularly in the machinery and equipment area of the exports. And they are related to sector-specific issues and company-specific issues in these sectors, as well as a more broader slowdown in international trade that's coming on back of both the Chinese issues, but also the increases in the interest rates more generally. These charts both give a comparison across goods and services for Ireland on the left-hand chart, but also across countries on the right-hand chart. We can see this differential story occurring in an Irish context. While overall exports were down, the green dot here, nearly 3%, in the second quarter of 23, we can see that services are holding up pretty well, but goods are coming down quite rapidly. Again, is Ireland different? Well, actually, if you look at the chart here, all the big economies in Europe, the EU27, the EA, which is the Eurozone area, and baskets of southern economies, there's a generalized slowdown in export growth across the board. And this is indicative of the international headwinds that we see on the horizon for the traded sector. To maybe just show you specifically about the specific subsectors that are doing well and not doing well, chart on the left-hand side here looks at the service side. And I think contrary to our expectations and many others' expectations, the ICT sector is holding up well. I think coming into the year, we were worried about this sector a little bit, given the very publicized international employment retrenchment that they'd gone under. But the exports for services, computer services, have held up pretty well. But you can see on the right-hand chart here, the goods exports, it's pharma and it's the machinery equipment that's pulling down our overall exports. Okay, so with that, I'll hand over to Kieran and look forward to any comments and questions later.
Thanks, Conor. So just continuing on the theme, I suppose, of the slowdown that we observe in some of the major kind of growth channels. In terms of investment, you can see there we've split out the kind of headline overall investment figure and the modified investment. Obviously, the difference being things like aircraft leasing and patents around R&D, certain R&D related activities. And you can see in both contexts for 2023, we're expecting quite a slowdown in investment, the growth in investment. Now, we should explain there is a kind of a base effect in there from 2022. There was a big investment surge early in 2022, which we think is related to one particular firm in question. And so that's led to a particularly high investment figure for 2022. So it was always going to be, relatively slow growth rate in comparison this year. And you can see the historical trends there on the right-hand side of the graph. But quite apart from that, there's no doubt that there is a general slowdown in investment rates, and that really is not altogether surprising, both from a domestic and from a global perspective, with the very, significant contractionary monetary policies that are now in place across monetary authorities globally. It's inevitable that you are going to have a slowdown in investment with interest rates rising. And indeed, recent work by Conor, Paul, and Owen Kenny there, it's very interesting in terms of the simulation exercises that were done, looking at how increased policy rates had led to noticeable declines in investment for construction and other domestic sectors. And these effects in general are more acute, I suppose, for SMEs, in the sense that they do exert downward pressure on new investment because of obviously the increase in the costs associated with investment related to higher interest rates. In terms of housing output, I think what we're seeing on the housing side is, it's still quite hard to work out the underlying trend in housing supply because you've a lot of oscillations, kind of peaks and troughs related to COVID-19. So you had the suppression of activity initially on the supply side because of some of the public health measures. When those were eased, then you had a kind of a big surge in activity. So you're still trying to get a picture of the underlying trend. But what we do notice is that the output is slowing this year, but commitments levels do appear to be rising. And again, the growing interest rate or the increase in interest rates is going to have a negative effect on housing supply. There's no doubt about that. Given all those factors, we still believe completions will be somewhere in and around 29,000 in the present year, growing to 30,000 next year. But I think as a more general point, it is likely that, as I said, the private sector in particular is going to struggle with increasing supply over the coming years because of the higher interest rates and the cost of funding pressures associated with that, but also, of course, because higher interest rates will have a negative effect on the demand side as well, because it will reduce affordability. We have a box in the commentary, which just as a kind of a counterfactual exercise, just based on a presentation that I did down at the DW last week. We looked at the implications of what would have happened if we had higher levels of housing supply over the last over a certain period of time. So in particular, between 2012 and 2017, my colleague Paul Egan, using Cosmo, simulated the impacts of what would have occurred if we had been able to, produce 15,000 housing units each year over that period. So what would have been the effect on house prices in particular if we had been able to increase supply? Obviously, at the time, the state wasn't in a position to do that because of all of the conditions associated with the bailout and because of the fiscal situation we were in. But nonetheless, if we had been able to do it, a kind of a what-if scenario, we show that house prices would have been down quite a bit by the end of 2017. So they would have been down around 9% relative to where they were had we been able to increase supply over that period. Next up, if we look at the labour market, we see again very strong performance in the labour market. We see the unemployment rate essentially kind of bottoming out at around 4%, and it's in effect been at 4% since May of last year. You've seen significant employment growth over that period. We're plotting the vacancy rates there as well, and you can see again we're at a particularly elevated high level towards the end of 21 and into 2022. They are beginning to dip somewhat. But still they're at a very elevated level. Wage pressures clearly are still going to, you are going to see significant wage pressures over the next period of time. And that's because of the tight labour market and also because of the higher inflation rate as people look to, I suppose, maintain real income growth over the period. You are going to see further upward pressure on wage rates. In terms of inflation, which of course is the crucial factor, what we see there, we do see inflation easing as energy costs are falling over the last period of time. Conor just move on. Yeah, cheers, thanks. So you can see the inflationary pressures are certainly easing in the economy, but they're not easing as quickly as what we thought they would in previous commentaries this year. So you'll see that our headline CPI rate and our HICP rate are actually up compared to what we felt they would be in the last commentary for the present year, but they are still coming down from the very elevated rates that they were in 2022. And we continue to see, expect inflation rates to fall next year. And clearly that's associated with the recovery of supply chains and energy markets, and obviously the delayed effects associated with interest rates, which will ultimately have a suppressing effect on inflationary pressures. Of course, in the short run, higher interest rates do, because of the way in which housing costs are calculated in the CPI, higher interest rates do feed into higher inflation rates in the short run, and that's to do with the way in which housing, as I said, housing costs are measured in the CPI. If we move on to tax revenues, we see again continued buoyancy as far as tax levels are concerned. Mainly though in the headline figures of income tax, VAT, and corporation tax, so they're continuing to register very strong growth. You can see the growth rates there for the year for January to August: 8.2% for income tax, 11% for VAT, 7.3% for corporation tax. And, you know, again, I suppose signifying very, very strong growth, underlying growth when you have those levels of increases in tax rates. I think a crucial factor certainly will be, as far as corporation tax are concerned, I think the November returns this year are going to be particularly interesting to see whether you still have that strong growth in corporation tax for the year as a whole, compared to the very significant increases that we saw and observed last year. We've factored in a relatively modest rate of growth, as we always do, until we observe what the actual figures are. But as I said, the November returns are going to be particularly interesting in that context. Next up, we have a box which looks at the distribution of tax receipts on a historical basis, and in particular, I suppose, highlights the growing role of corporation taxes, as you can see there in the graph on the right-hand side, the top graph on the right-hand side. So basically what I've done there is I've looked at the share of taxation receipts coming from income and VAT, which I gathered together in the yellow line, and then corporation taxes in green, so its share of the overall take, and then the other category, which basically consists of things like excise duties, capital gains tax, capital acquisition tax, etc. You can see that corporation tax has surpassed those in importance since around 2017, 2018. Those items, particularly capital gains tax, and stamp duties, were very important back in the 2000s when you had the property boom and the nature of the taxation system at the time, but they have certainly diminished in importance relative particularly to corporation taxes since then. We also do a very simple kind of counterfactual exercise for income tax and corporation tax. In the box, what we do is we look at what would have happened to those taxation receipts post 2020 if they had continued to grow on the basis of the average between 2014 and 2020. So what we're trying to see is almost take the COVID scenario out of the equation to see how those tax headings would have grown. So you can see the counterfactual tax levels for income tax and corporation tax in the graph. The corporation tax counterfactual is in green, the income tax one is in purple, and then we contrast with what actually happened. So how receipts actually evolved over the last 3 years. And it's interesting to note that whilst obviously actual taxation receipts dipped during COVID, and you can see that in terms of the difference between the counterfactual and the actual, but after 2021, you can see that the actual levels surged relative to what the counterfactual would have been. So that's just an interesting, I suppose, stylized fact of how the economy has recovered, and particularly how income tax receipts have recovered since COVID-19. A final box then that we look at, particularly in the context of the budget, is we benchmark Irish expenditure levels. So what we do is we look at expenditure both in terms of current and capital expenditure. We compare Irish expenditure levels across Europe over the period 2001 to 2021. We do it on a per capita basis, so we divide the expenditure levels across all countries by the population, the working age population in the country for the period, and then we compare it across time. And for Ireland, what we do on the top graph there on the right is we just look at how Ireland ranked in terms of its expenditure levels, so in terms of current and capital expenditure levels over the last 20 years. What's interesting to see is that I think in terms of current expenditure, we've typically been around, the 10th highest in terms of expenditure levels, as far as current expenditure levels are concerned. And that's been relatively constant over that period. However, on the capital side, you can see that we've oscillated around quite a bit. So back in the early 2000s, we were one of the highest spending countries as far as capital expenditure was concerned. So we were ranked around second and third. Then, however, we fell off quite sharply after the financial crisis. And again, because capital expenditure really eased considerably during that time. And really, it's only in the last couple of years that capital expenditure has begun to increase. And you can see that in terms of our ranking relative to other countries. So we're back up to around, the fifth highest in terms of capital expenditure. But I guess the point is that capital expenditure really has varied substantially over the last 10, 15 years. And, we see the effects of that, I suppose, in areas such as housing and other areas, we'll say, where infrastructural deficits may, exist in the economy. What we also plot there is just comparing expenditure levels with GNI star. So just to see how, expenditure levels compared on a historical basis for Ireland. And you can see that particularly, I suppose, in terms of capital expenditures, the yellow line there, we're down quite a bit compared to, for instance, where we were just before the Celtic Tiger boom ended in 2006, 2007. So you can see back then, we were at around 6% of GNI star. Now we're back down to just over 3%, if you like, in terms of capital expenditure. So, there are implications, I suppose, for the domestic economy because of that, given the kind of the substantial variations in investment during the period. So finally, then on the assessment, I think what we see is that the economy definitely is entering into a phase of more moderate growth rates. I think that was inevitable given that, the surge in growth rates that we observed in key sectors such as ICT and pharma really were unlikely to continue into the medium term. We still believe those sectors will perform well, but just not at the very elevated growth rates that were experienced during and after COVID-19. The domestic sector, we believe, is continuing to grow, and that's why our MDD forecast is positive for this year and next year. But there's no doubt that the Irish economy, as we've, as has traditionally been pointed out, being small, open economy, is susceptible to international and global conditions. And particularly the contractionary monetary policies that are being pursued and the higher interest rates undoubtedly are having an effect on international trade and consequently on the export outlook for the domestic economy. Finally, just in terms of the budgetary position, it's clear that the economy is really, operating pretty much near to full tilt with unemployment at 4%. And with inflation at 6%, it really does, I suppose, make fiscal policy quite, tricky, to be perfectly honest. The government is in a, relatively unique position with the surge in taxation receipts that have been observed over the last few years. We believe the reserve fund, which has been set up, is a very good idea in terms of delineating out between the surge in revenues that's sustainable and those items that are not, or that element that is not. But it's clear that the government still needs to invest in the domestic economy, particularly in areas such as housing and other areas, climate change, for example. And so really fiscal policy has to strike a balance. On the one hand, in terms of maintaining the investment levels that are required in the domestic economy, but also ensuring that it doesn't, additionally fuel inflationary pressures that are in the domestic economy at present.